They absolutely are pawns. They're single-player movers in the game.
If you stay alive long enough as a pawn, you get promoted to queen.
If the goal is to create life-changing money for you and your family, you shouldn't be a founder in the first place.
There are better ways to not have a boss. I've actually heard founders say, oh, I don't want to have a boss. That is a dumb reason to start a startup, right?
There should be a lot of warning labels on this thing. I'm a founder. I love it, except when I hate it.
I feel like we're not making a very good pro case to be a founder here, gents.
You're listening to the Startup Podcast. This is an educational episode.
Hi, I'm Yaniv Bernstein.
And I'm Chris Saad.
And I'm Peter Walker.
If you ask 6 people in the startup community for advice on how best to raise capital, you'll get 7 different opinions. It is so confusing for founders trying to understand what actually makes sense. What's the right valuation? How do we speak to VCs? What's the right amount of dilution? So many different things. And opinions mean nothing when you have got data. There is a lot of data out there about the best way to understand the fundraising scene. And to dive really deep into that and what the data teaches us, forget conjecture, we have the perfect person joining us. I'm so excited to introduce you to them right after the break. Today's episode of the Startup Podcast is brought to you by Cyber Matters. Cyber Matters helps startups and scale-ups get security compliance right the first time. Building a startup is hard enough, believe me. Founders do not have months to waste on paperwork, or even worse, dealing with the fallout of bad advice. The team at Cyber Matters run managed GRC programs, internal audits, and risk reviews, all designed to fit how tech companies actually work. From SOC 2 to ISO 27001, they cut through the noise, set up platforms like Carta, and keep you audit ready without slowing you down. Cyber Matters, practical security done properly. Visit cybermatters.io to get started. Peter Walker is head of insights at Carta, which is one of the world's largest platform for managing cap tables and fundraisers for startups all over the world. That means his full-time job is diving into this absolute treasure trove of data that Carta maintains and drawing out all the insights that he can about what is going on out in the world of fundraising, what was always true, what's happening right now, and what it is that founders, investors, and everyone in the startup scene can learn from that. So here's an absolute treasure trove of wisdom. I've been really enjoying going through a lot of his content, and we're going to really dive into the greatest hits and what you should be thinking about fundraising right now with Peter. So excited to have you, Peter. Welcome to the Startup Podcast.
Really excited to be here. Appreciate the invite.
The first thing I thought we would talk about is we have listeners in over 100 countries, Peter. And so a lot of the time you're scrolling through LinkedIn and you read things about, this is the fundraising dynamic right now. This is what the pre-seed and the seed are, and this is how frothy it is and so on. And one of the things that I noticed that you've been focusing on at the moment is really talking about the fact that every market has its local dynamics, and that what might be true about the Bay Area and Silicon Valley or the United States might not be true in Europe. It might not be true in Asia or Australia. And so what is it that you are seeing in terms of these local market dynamics, and how should founders be thinking about them?
So I think it's important for founders to keep abreast of whatever is happening in their local ecosystem for 2 reasons. The first is obviously they're going to be interacting with those local VCs. The dynamics of the deals might be different. You don't want to benchmark yourself to something that is not where you live and the ecosystem that you're living in. The other more important thing is on a psychological level, the valuations and frenzy of San Francisco in particular dominates the headlines. It does so in the US for non-San Francisco markets, and candidly, it does so globally as well. And those valuations and those dynamics do not exist outside of San Francisco. So benchmarking yourself to Cursor or some of the biggest raises that you've seen this year can be really emotionally fraught for founders because that is not the world that they're actually living in.
Yeah, you showed a really interesting graph lately, Peter, which sort of showed that of the sort of top decile or even top 5% or top 1% pre-seed and seed raises, the higher up you go, the more it is dominated by, first of all, San Francisco, secondly, New York City, and everywhere else just gets squeezed out. So I guess a question, and I don't know if you have data on this, but maybe you have an opinion, is does that mean that if you're a founder who is very ambitious, should you move to San Francisco?
If your goal is to get the highest valuation for your company, absolutely. I think it's actually incontrovertible that it is more likely for you to get a top decile, top 5%, top 1% valuation in SF than anywhere in the world. This begs the question, is that a good thing for your business? Should you be aiming to have the highest possible valuation, and should that be the criteria of success? In that case, I think the data is far more muddled, and I would probably say that in many cases, the highest valuation is putting you on a path towards a down round, not actually ultimately exiting for a ton of money. So it's pros and cons, but there is no doubt that the capital markets in SF are just completely different than they are in most other places around the world.
This is exactly the right question, and I guess it wasn't the original topic of the episode, but I think I almost spend an hour on this because, there's this age-old debate of like, do you have to be in San Francisco, do you not, and does it matter, and, does everyone have to play the same game Silicon Valley's playing? Maybe let's ask a different question related to this. Do you have any evidence, any insights, any analytics that shows, irrespective of valuation, but long-term value creation, sort of failure rates, impact rates, exit rates, is there any signal that shows that there is certain markets that perform better than others? And I'm actually not interested in valuation so much as I'm interested in capital availability. Are these companies getting funded to win, or are they getting funded to die in big, spectacular flameouts? And maybe is there another narrative that's not being told?
So much to dig into there. I mean, I guess the first question is, are they being funded to win or funded to die in flameouts? The answer is both, of course. You have to accept the flameouts in order to have the wins. I think the nuanced question, though, is, are there places around the world where capital efficiency is much higher than it is in SF, even though the total value of the exits is lower? And I do think that, Australia and other ecosystems could very reasonably say, we may not have as many massive exits as the Bay Area does, but on the exits we do have, they have grown much more capital efficiently than some of the US unicorns. I think that's probably true. In general, though, I do think that the Bay has the highest exit absolute value. It also wastes quite a lot of money because it's pretty easy to waste money if you're investing into $200, $300, $400 million rounds, and there's only going to be one winner in this sector. There's multiple companies that get those kinds of funding. So waste is part of venture in a way that I think is very difficult for people that are not in startups to understand. When you're in an industry that expects to miss 9 out of 10 bets, the waste is not a bug, it's a feature.
Yeah, I guess this is such an interesting, you've got to circle in on what matters here, right? So yes, the valuations are bigger. Yes, the waste is bigger. Yes, the exits are bigger in absolute terms. So now let's talk about sort of the incentives and whether people's incentives are being met. So are the returns on a percentage basis for investors in Silicon Valley better? Or are they in sort of slower, safer, more efficient markets? Are they better? And then returns for founders, maybe not in absolute terms, I think Silicon Valley would win, but in sort of like the outcome of, their blood, sweat, and tears, which game wins?
I think on the fund level, so returns to investors, obviously the hidden dynamic within that is fund size. Wherever you are in the world, the ultimate multiple on your returns is going to be dictated first and foremost by how much money you have to invest. So when we talk about these mega funds, Andreessen, Sequoia, Index, et cetera, they are concentrated again in the Bay Area, and they are investing capital at a rate that we have never seen before. The idea that a venture fund might raise $9 billion is a completely new phenomenon over the last, call it 5 to 10 years. It didn't exist before. And the idea that $9 billion will result in the same multiple that a much smaller fund will is completely nonsense, right? And LPs do not actually expect that. They can do math too. On the founder side, I think it is completely reasonable to stay and argue that you are more likely to achieve a high quality exit as measured by the amount of capital that flows to the founder and the employees in a non-SF market, given that the valuations are going to be slightly lower, the goal is more achievable, and the likelihood of an ultimate exit slightly higher. I don't have exact data on that, but I think that's a completely reasonable argument to make. When you talk to people around San Francisco about this, they use words like ambition almost constantly, right? If you are the most ambitious sort of person, you need to move to the Bay. But ambition does not always equal revenue generation and value generation at the end of the day.
I mean, the way I sort of be thinking about it, and someone I spoke to, a VC I spoke to said, the way to think about early stage valuations is that the investor is buying an out of the money option on your startup, right? So if you're raising at a given valuation, 10, 20, $50 million, your company is not actually worth 10, 20, $50 million. It's not really worth very much at all. So they've got an underwater option, an out of the money option. And the bet is that at some point, you're going to be at a much higher valuation and that option will become worth a lot. So I guess the higher the valuation that you are raising at, the more out of the money the option is. And so the higher the expectation is on you to actually achieve that massive exit. And so you become more and more and more risk on. It becomes more and more all or nothing, right? If you are raising pre-seed at 50 million, you're pretty much saying unicorn or bust. Trying to become a unicorn means your odds of failure are higher. So yes, ambition, but ambition, I would say, Peter, coupled with risk tolerance, with risk appetite, right? We're saying, you know what, I am okay just throwing everything I have at this and most of the time just failing.
100%. I think you hit the nail on the head. High valuations at the earliest part of a company's journey are, one, not a true reflection of the underlying value of the business on the day of that round. And two, out of the money options is exactly how most investors think about it. The dynamics in this case are upended a little bit by different funds with different strategies competing for the same underlying asset. So if you are a small manager managing, say, $25 million, you cannot play, generally speaking, in a market where pre-seed valuations are $50 million. One, you don't have the capital to play in those rounds. And two, the entry price is not low enough for you to make this fund economics work. Whereas if you have $1 billion and you're willing to play at seed stage, you are much more price insensitive because the goal is not to win at that round. The goal is to be a part of every fantastic startup. And then the ones that make it pour more and more capital into those over time because you've got $1 billion to spend. So again, these different capital games are being played with the founders. I wouldn't say they're pawns in this ecosystem, but they do need to think very carefully about the incentives of their funders because that will in turn dictate the growth dynamics that matter for their business. Taking money from a mega fund is different than taking money from angels or smaller funds.
I'm obviously very enthusiastic about the entire startup game, right? We wouldn't be doing this podcast if we weren't. But I do think that a cynical or skeptical worldview would say that they absolutely are pawns. They're single player movers in the game and they are being farmed, right? From the Y Combinators to the Andreessen Horowitzes to try to create value for investors. And they want young, hungry, ambitious people who are willing to work all day and all night to get shit done. But that doesn't necessarily mean that the pawns are not aware of and playing the game as well.
If you stay alive long enough as a pawn, you get promoted to queen.
Exactly. So there's, everyone's playing a game and you have to be sober and aware of the game. What I guess just to not to belabor this point, but maybe to get to the end of it and decide we don't know, or maybe we do know. What I'm most curious about is, I think it's clear if your goal is to make an impact, to make a dent in the universe, as Steve Jobs would say, it feels like to me that Silicon Valley is a slam dunk. If your goal is not to, have a middling success, you want to make the biggest possible impact or die trying, Silicon Valley seems like the obvious slam dunk. But if your goal is to have sort of make life-changing money for your family and just to have an exit that is really meaningful, but it doesn't have to be the biggest thing ever. What I'm wondering is, what is the hit rate in Silicon Valley's model versus another place that's maybe more conservative? Which one should you choose? The slow and steady with the more conservative capital, or is it because there's so much going on in Silicon Valley, even these big swings are at least producing pretty good outcomes for more founders? Do we know which one it is?
I wouldn't say that I know exactly. But to be slightly devil's advocate here, if the goal is to create life-changing money for you and your family, you shouldn't be a founder in the first place. There are many, many, many safer routes towards life-changing money than becoming a founder.
I love that answer, Peter. I love that answer.
Don't be a founder to make money. That's usually a bad idea.
That's right. There are a lot of bad reasons to be a founder. And, we spend a lot of time on this show talking about the idea that startup is short for Silicon Valley style, venture scale, game-changing, disruptive startup. It's like startup is the last word of a lot of qualifying words, right? But, these days, anyone with a small business or an agency calls themselves a startup founder. And we're often reminding our audience that, we're not a show for you if you are a small business agency, creator, right? Operator. And so, yes, I love your answer, which is, there are better ways to not have a boss. I've actually heard founders say, oh, I don't want to have a boss, or I don't want to raise money because I don't want a boss. Or that's why I do my startup. Like, whoa. That is a dumb reason to start a startup, right? Or it's like, I want to make life-changing money and walk away. I don't really want to do all this big unicorn stuff. that's a less good reason to be starting a startup than I have something burning in my heart. I'm like Neo in the Matrix. There's something that's like affecting my brain, and I can see that the world could be a better place, and I'm gonna fix it. That is the very best reason, and again, why long time listeners of the show will know that I'm a big advocate of like pick up your laptop and move to the Bay Area because it's the only place to really play this game in kind of in the A tier.
Maybe to tie a bow on this, the other thing that has happened is that when you look across the media around startups, venture capital is good at many things, but it is best at talking about itself. There is no alternative to, there is no bootstrapping media complex the way that there is a VC media complex. So it can feel as though this is the default way, and maybe perhaps the only way to create a startup that's worth anything. And it's both because VCs are good about talking about it, but it's also because the VC model gives you checkpoints, regular checkpoints where you get to talk about progress in a way that a small business never does. There's no regular Series A where you get to say, oh, we funded at this round and we're so excited to bring on these engineers and we've changed the world in X or Y way. So I kind of understand why this can get lost in the muddle, but you're right. Startup probably implies for most folks many, many qualifiers before the word startup. And in some ways it shouldn't. There should be a more diversity of the models of company creation.
Well, if you're not taking outside money, you have nobody setting your valuation, and the valuation isn't skyrocketing by, as a result of that. So yeah, not only are there not clear checkpoints, there's no clear, pricing.
Well, there's no narrative. Yeah.
Yes, there's one pricing event when you sell it to a private equity firm after 25 years. Yes.
That's right. Exactly. And they strip mine it for parts.
Now, Peter, we like to play this game on the Startup Podcast, which is to see how long it takes until we mention the term artificial intelligence. We've made it about 15 minutes, but I think now we have to go there. So we've talked about local market dynamics. We've talked about SF versus the rest, but there's another dichotomy, right? Which is AI versus the rest. That's layered on top of that sort of haves and have-nots. And I saw one stat that you shared is that in the past 4 years, AI startups have gone from 23% of all venture funding to 48% of all venture funding. And that's just from 21 to 25. Talk to us a bit about this sort of AI bubble, what that means for founders, I guess, both who are doing an AI startup, but also very meaningfully for, I think, numerically, there's still a much larger number of founders who are building something that is not what you would call a core AI startup.
I'm proud of us for taking 15 minutes to get here. Here's the deal. The first thing you have to talk about when you talk about AI is give us your definition. And so in this case, what we have decided to call AI startups are those in which AI is core to the product or operations of the business, which is a very broad definition, right? Many VCs in the Valley would disagree with our definition that we use for these reports because they would say, no, you have to be building your own models or fine-tuning a model with real data or X, Y, and Z. And yet other VCs completely disagree with them and say, actually, if you're calling ChatGPT and improving your customer service tickets, that counts, right? There is no clear definition of this. Number one. Number two, when you look at that trend of growth over time, two things are happening. One, yes, there are many, many, many AI native startups that have been founded since, say, 2023 that are coming to dominate categories. On the other hand, there are many non-AI native startups that were founded well before this ChatGPT wave that are increasingly adopting AI technology at a rate that we have very rarely seen for later stage incumbents or indeed public companies. So everyone kind of feels like an AI startup, even if that's not what you were 5, 6, 7 years ago. And this gets me to the main point. When it comes to software, I don't think this AI versus not AI distinction is going to be very useful for much longer. My expectation is by the time, a year or two from now, I will retire this chart because every time you're building a software company, you're utilizing AI in some way, shape, or form to write the code, help whatever. And does that count? Or do we just talk about them as fintechs and gaming and marketplaces just as we used to?
It reminds me of, I had a founder, in Australia in particular, there's sort of this cohort of people that come from the old world and they use words from the 90s, like portal or a digital platform. And I had to, remind this particular founder, like, please don't call it a digital platform. And it's sort of like, the more modern version of this is cloud or even SaaS, right? Calling, your product a cloud CRM or something. It's like,
My startup is all about hypertext. It's amazing.
really, mine's about IRC.
Multimedia.
Oh my God,
I love
multimedia.
it.
Yeah, it's going to become, it is fast becoming one of those terms that's just baked in. It's another tool in the tool belt. And yeah, I think, the idea of a startup, another thing that's baked into the definition that people take for granted is that you're using software to drive massive efficiency for you and your customers, right? That's where the disruption comes from. And a big part of that quote unquote software efficiency these days is powered by generative AI software. And so it's really just an evolution of the way the software is built, executed, and operated. So yeah, but the other thing we've said on the show is if you're not building an AI startup, why the hell not? Which is another way of saying, if you're not thinking about the problem you're trying to solve from first principles, and the first principles currently include generative AI, then you're literally missing a basic trick of technology and software development. So it doesn't make any sense.
100%. There's no reason why you should be looking askance at this technology if it's going to help you solve problems for customers at a faster pace. That's just kind of silly and baked into the definition of a startup. I will note there are many, many companies that are not yet using AI that are building in non-software capacities. Now, some of those are going to start getting infiltrated by AI as the mix between hardware and software combines. Robotics, biotech, et cetera. All these places are going to be transformed by AI over time. But it's not as though every single startup on Carta has to become an AI company, for instance, or they're going to die. That's not the case. There's just very little appetite, especially in the core venture markets in the US, for non-AI software companies that are just kind of ignoring it for ignorance sake.
Even traditional companies like healthcare companies or insurance companies should by now have a big, important software strategy. And equally true now, they're going to need to develop an AI strategy. But even if they don't do any of that, they could have inherit the software and AI from the vendors, right? The tool vendors, right? So if you're using Salesforce or Office 365 or whatever, software and AI has infiltrated and will continue to infiltrate your organization and your industry.
Guys, while I agree with everything that you've said, I think, Peter, you said maybe at some point you'll be retiring this chart, but I don't think yet. And what I wanted to sort of dig in with you is that I do feel there is this kind of two-speed economy in tech still, where you've got these core AI startups, your Cursor or your Lovable or whatever, who are raising pre-seeds in the hundreds of millions, billions of dollars sometimes, growing like crazy and kind of sucking all the oxygen out of the room. And then you've got everybody else who is, of course, trying to leverage AI and solving the customer problem that they have. But I don't think, I'm interested in your data-driven thoughts here, I don't think they're commanding the same sorts of valuations or interest as companies that have a very, very straightforward AI narrative. Is that true right now, or am I off the mark?
It's definitely true. I would say that a lot of the narrative around those, whatever you want to call them, Bessemer venture partners call them supernovas, which is companies that hit $100 million in ARR in the first 2 years of existence, growing at rates that blow out the old benchmarks of what a great company growth might look like. Those companies exist. They're not a very large percentage of all companies, and they're even not a very large percentage of all companies that are getting funded by VCs at the moment. What they are is the target and darling of every single mega fund in the world. They want to be in these hyper-growth hyperscalers as much as humanly possible. And we don't even need to talk about the fact that most, or candidly, I would say close to all of those companies are not profitable, right? They are growing incredibly quickly, but they are spending a ton of money to do it on compute and other things.
And also some of them have very low quality revenue as well, right? People who are trying stuff out, bumping into walls, going, this thing doesn't really do what I want, and churning out.
Some of them definitely do. I would say that we're what? ChatGPT announced the chat interface in November of 2022. So we are pretty close to 3 years on from that. Some of these startups have been through multiple yearly cycles of renewals, at least the ones that are a little bit, more B2B. And they are holding on to revenue pretty decently. Some of them are not. Some of them are leaky buckets. But it's not the case that every startup that is growing incredibly quickly also, by default, comes with a leaky bucket in terms of churn. There are some that are trying to marry the two and doing a pretty good job of it. What they're not is profitable, almost always. And that just comes to the idea of, when is the token economics going to make sense, the compute power, et cetera. You asked, Yaniv, about a bubble In startups, I don't think that there's a bubble per se in the idea of AI is a transformational technology. You should be using it to help build your business. In
100%.
broad economic terms, are we building too many data centers? Are we likely to suffer some dip in this growth, and maybe the infrastructure that we've built is not going to be used at nearly the pace that people expect? I think that's a completely open question, and many people would argue yes. I don't think it's a bubble necessarily on the idea that all of these early AI companies are just going to be exactly like the dot-com boom and not worth anything.
Cool. So, I mean, there are a few things that you've sort of touched on that I'd love to dig into on this, Peter. So the first is on growth expectations, right? And I know you've commented on this in a few of your recent posts. And there's the old T2, D3, triple, triple, double, double, double benchmark for SaaS companies, right? And some people are saying, well, that's obsolete, right? Where, with these AI companies growing so fast, that's not fast enough anymore. Now, do you think that's true? Or is this, again, just a bit of hype and something that applies to a few exceptional companies, but not so broadly across the board?
I think the folks that have said things like triple, triple, double, double, double is not interesting to us are being honest when they say that. But they don't speak for the entire market. So I know many venture investors who would be more than happy to invest into your triple, triple, double, double, double company. What needs to be true today, which perhaps was a little less true in the core SaaS era, is that triple, triple, double, double, double better come with fantastic unit economics and incredible retention, right? Because what has happened is whatever the top part of the market used to be, it has been blown off with AI. So if great growth doesn't look like triple, triple, double, double, double anymore, then that kind of growth needs to come along with better underlying financial economics. But that doesn't mean that those startups are unfundable by any means. I think that a lot of companies will get funded at kind of that pace, maybe a little bit faster, but they'll need to show that their retention in particular is fantastic. The quality of their revenue is really good. They're building an enterprise moat, whatever it is. It is not as though you need to, if you're a founder listening to this and saying, well, I'm not growing as fast as Cursor, should I throw in the towel? That should not be the message that you take away.
That's right. If you're not Cursor, go home. Maybe just to dig a little bit deeper, I don't know if the data is showing any of this yet for you, Peter, but if you take that broader cross-section of startups, the fact that they're all able to leverage AI tooling internally, but also in the product itself, has that changed the growth profile of startups, either in terms of revenue or in terms of time between raises or valuation multiples between rounds or anything like that?
Yes, I would say definitely. The growth, it used to be the talk in Silicon Valley was if you have $1 million in ARR, you can raise a Series A. I'd say that's on quite the low end these days. You're talking more like $3 to $4 million in ARR, then you can talk to Series A investors. So that's a pretty big increase. We have had inflation. Most people don't factor in inflation to these numbers. So, maybe it doesn't look quite as bad as all that, given we're up, 20% inflation since 2021?
I think there's also like round title inflation, right? Now, if you can raise a pre-seed at 25 mil and a seed round at 60 mil, like Series A used to be the first round, right? So it's sort of like, yeah.
I mean, this is a personal hobby horse of mine. I think the idea that we just expected these alphabet names to mean the same thing over time is just messes with people's heads. It's not true. It's never been true. It's not true now. Series A is literally just a random name that we put on this. We might as well call it, like banana or orange or whatever. And people do say mango seed rounds all the time now, which I don't love. There's all sorts of complexities there. And sometimes the optics of the round name are being used in service of the founder. So the founder might go, look, we could raise a Series A, but instead we're going to raise a Series A seed extension because those metrics are much better in that narrow slice of the market than if we had called it a Series A and we're just doing a little bit of name arbitrage.
The other area I wanted to dive into with AI in particular is, I guess, two related things. So first of all, team composition. I noticed you've got some data that shows that team sizes are trending lower. Not surprising at all, right? With the extra leverage you can get from AI. So on the one hand, we're seeing this change in team composition. On the other hand, we are seeing large rounds. And my question is, has the use of capital changed, right? Because traditionally, the reason you raise a whole bunch of money is to hire a whole bunch of people. You've got by far the biggest bucket of expenses, people, then you've got marketing, then you've got everything else. Is that changing?
100% it is. It has changed. What's going on the employment side has been a pretty massive shift, to be honest. So we track employment data for about over 1 million private company employees. And obviously, we manage the equity for those employees on Carta, but we also have products that help founders figure out what to pay them in salary. So we have HRIS connections to the salary, so we get very good data on employee comp. Right now, the main thing around startups is we want to build a lean team that moves very quickly. So what does lean mean in this case? Well, it used to be that a Series A company on Carta would have 25, 26 employees when they raised that Series A round. Today, it's more like 17. By the end of the year, we think it's going to be more like 15 or 14. That's a big shift in the number of full-time equity holding employees that work at your company. To your point, what are you spending money on if you're not spending money on headcount? Well, it turns out you can spend a lot of money on compute. If you are an AI native startup, that is one place that has skyrocketed. You can spend a lot of money on AI tooling that might not necessarily be compute, but other AI tooling that improves your tech stack. And then you're spending money on distribution. As company cost creation goes down and niches get filled more quickly, the ability to stand out through distribution becomes at a premium, and that usually entails a cost. I would say that it is not the case that all of these companies are necessarily that much more capital efficient than their older counterparts. They just have moved the capital stack around a little bit.
Well, they're not as efficient, or they're not more efficient right now because it's so frothy and there's so much, competition in the distribution channels, and the tokens are still quite expensive. But the bet is that over time, the tokens, drop towards zero, and that the market becomes less frothy, and therefore the cost of distribution goes down. That's the bet.
This is the question. How defensible are these new startups? It's a age-old question around VC, which is, it used to be, what if Google builds this? Which everyone now laughs at because Google has had so many graveyard products that didn't end up going anywhere. The new question is, what if OpenAI builds this?
Or what if the large language model can build this on the fly?
100%. That's a little scarier, to be honest. I think if VCs in the Valley are taking that more seriously. So what is a moat? What is defensibility if you can spin up a similar product in a weekend? I think that, first of all, that is a rather flippant way to say it. It's actually not possible to do that in many cases right now, but it's getting closer every quarter. And then there's a big question. So that's why you have people who are predicating their rounds on this massive growth, because at least the growth buys you brand or buys you time. But to be honest, I don't think that everyone has a really clear conception of what defensible truly means in startups in the AI world.
Yeah, but I mean, it's kind of related to theory of constraints, isn't it? Right? Like if it becomes really easy to build software, then the nexus of competition moves somewhere else. It
Correct.
never gets easier to win in a competitive environment, right? The nexus of competition simply moves. And I think use of capital is a clue to that, isn't it? Where we can now say building software is a lot easier than it used to be. That means that something else is becoming more competitive and harder. And so, yeah, I think it's fascinating to watch that change, that we've got more money being raised than ever, but smaller teams. The money's still being spent.
Absolutely.
Yeah, my hypothesis for a long time, Peter, and I'd be curious to hear your thoughts on it, is that the only defensible moats in AI over the medium to long term is, yes, truly proprietary data, although I think it's harder and harder to find truly proprietary data. It's large-scale multiplayer. So when many, many people need to play by the same rules, so think of social networks or video games, large-scale multiplayer video games, or real-world manipulation. So think of Uber or Airbnb, where there's physical assets that the AI can't go do, by itself. I think a lot of the other stuff, if it's a tool for a small business or a tool for personal use and utility, it's hard for me to see how your personal LLM doesn't just go generate that on the fly for you or your little business.
I agree. I mean, there's a part of me that says, look, it wasn't as though no code tools erased whole software categories, even though it was technically easier for internal people to build their own software. I understand that AI is a magnitude of difference there, but there's a part of me that says that we are just lazy enough that we won't go build all of our own stuff. But that's as not an investor, I think it's pretty easy for me to say that kind of thing.
Yeah, I think it becomes so invisible and easy that you don't even think of it as building, right? You like spinning up a Google Doc or spinning up an Excel spreadsheet. You'll just spin up hey, we need to automate this process. I need you to do this, and this.
And this is there's precedent here. This is exactly what cloud has done to technical infrastructure. Like people used to have to, rack their own servers when they were building a startup. Now you basically connect your GitHub repo to Vercel or Cloudflare or whatever you want, and you're in production 10 minutes later, right? And, so the question is, does more of building software look like that? And then where are you competing? I think it's fascinating.
I feel like we're not making a very good pro case to be a founder here, gents.
Well, you know what? I think that is right. Like, there should be a lot of warning labels on this thing. Like, I'm a founder. I love it, except when I hate it. But it's one of those things. You should go into it with your eyes open. It's not an easy place to be, but you will learn a lot, and you will be at the cutting edge of what is currently happening. But that means, you'll get cut by that cutting edge. Scaling fast? Congratulations. Do not let compliance trip you up. Cyber Matters makes GRC simple. Policies, audits, and risk management built for real companies, not tick box exercises. Go to cybermatters.io to learn more. That's cybermatters.io.
Hey, before we get back into the show, a quick reminder. Please don't forget to subscribe, like, and turn on notifications, and spread the word about the podcast. It helps us grow the show, which in turn helps us help more founders like you. Thanks so much. Okay, with that, back to the show.
So, Peter, I wanted to move on a little bit because you pointed out a few things here that I think are really interesting about cap table structure at pre-seed and seed, and the way a lot of founders don't really have good benchmarks for how much dilution they should be taking. And in particular, now that safes have really become the dominant way of raising these early rounds, that people often don't actually understand the fully diluted structure of their own cap table, and founders get quite surprised by how much of the company they've given away. So just interested in having you share your thoughts and insights here.
I feel like the SAFE, the simple agreement for future equity, it's about 10 to 12 years old now. And in startups, it can feel like, oh, of course, we use safes, et cetera. But it is a very odd financial instrument that doesn't really exist outside of startup world, where someone says, I'm going to give you a bunch of money today, and then you're going to give me equity in your business at an undetermined future point in the future here, and we don't actually know when that's going to be, and maybe it's going to be never. Kind of an odd thing, right? And the way that these things work with their valuation caps and discounts is that on the post-money basis, the safe, you can add up all of these safes. And we see this happen all the time with founders on Carta, where they'll raise one round on safes, good, clean, easy. They'll raise a second round on safes, don't really understand what that did to the fully diluted, but that's okay. And then they might raise 2 or 3 more rounds on safes, and they come to their first price round, and they've got 5 different valuation caps. They all convert, and the founder looks at their own ownership and goes, what the hell happened? That is a pretty common refrain that we hear from founders. So I think safes are founder friendly, but they are getting overused in very odd ways and perhaps outside of their original intent.
I would actually say safes are not particularly founder friendly, except in a very specific way, right, Peter? And the way I think about it is safes originated with Y Combinator, which explains why they're popular in startups and unknown anywhere else, because obviously they have so much clout in this ecosystem. And they were really designed to say, hey, we can't agree on a valuation yet, so let's just punt this. And, I think originally a lot of safes were uncapped and so on. But now, by the time you have a cap and you have all these discussions, you really do set a valuation. And what a safe does is it spares founders the headache of having to have real shareholders and get lots of lawyers involved and have a proper shareholders agreement. And you're like, oh, we're kicking that can down the road. That's what's founder friendly about it. Most other things are kind of more investor friendly, right? Because the cap is effectively like an anti-dilution provision, and especially if you post money. And I think that's where it gets confusing. The founders think it's a founder friendly thing, but to your point, when these things convert, they're like, oh, that doesn't feel so friendly. Now that I look at how much I've been diluted.
It's almost like a credit card, right? You're like spending money, but you don't really know what it's costing you. Oh, we'll pay for that later.
100%. I think I could make a pretty valid arguments on either side here. I think the founder friendliness is due to the fact that by kicking the can, as you said, on the valuation question, you do get the advantages of speed and convenience when you're fundraising in the early stage, which is a real thing, right? And the idea that you can take $25,000 from a few different investors, raise $500,000 in, a month or so, and then just keep building your business without having to go through the pain of the price round. I think it makes a lot of sense there. You're exactly right to point out there are rights that an investor receives by dint of the structure of a post-money safe that they would negotiate tooth and nail for in a price round, and you would probably never give them, like full ratchet anti-dilution, for instance. The investors do make out rather well here. In general, I think the problem with safes isn't so much in the way that they were originally intended. It is the way that we are just now avoiding priced rounds for longer and longer and longer. And you know what's useful is having a price per share in your company, especially if, hey, guess what? You don't actually end up
That's
raising
right.
that Series A and you need to do an acquisition or something. That's actually quite helpful to have a price per share and a real valuation and have done the structure of the whole business.
From my point of view, the reason safes were founder friendly is because they're typically used by a bunch of angels who don't have the time or the inclination to do any diligence.
Yep.
And the company is sort of barely more than a piece of paper. And so trying to figure out a valuation is beyond false precision. It's just nonsense. To me, it was less about the speed of the execution of the paperwork and more about the nonsense of trying to put a price on something that didn't have any momentum at all. And now it's become about paperwork and all this other stuff and, signaling of we don't even need to price this thing. I think the opportunity actually for a Carta, if you haven't done this already, or for a Cake, is to make the process of proper equity investment as easy and seamless and painless as a safe. Is like, how do we make it one-click invest through a series of vehicles and fractionalization and whatever? I don't know if it's something Carter's doing, but it's something it should be doing. Something I'd love to do.
Chris, I didn't want to pitch here, but if you're going to give me this entree, what a layup. Okay, so we do have a product called Deal Closings. And the goal of Deal Closings is to make priced equity rounds as simple and useful as safe rounds.
Oh, look at that.
We're not going to get there in one. There's a ton of different stuff you have to deal with.
Here's one we prepared earlier.
Exactly. So there's a lot of amazing stuff that Deal Closings does. It helps both on the lawyer side and on the founder side. We don't want to, by the way, disintermediate lawyers. The goal, we think that all startups need a great lawyer. They should be doing the negotiation. They should be deeply involved. What we want to do is do all of the admin work around that takes time and effort and kind of bullshit. So the tracking of signatures and packets and all that kind of stuff back and forth. We think we can make a really big difference on this kind of software. And because we're automatically connected to the cap, the fundraising flows through to the startup much, much, much more easily.
Peter, not wanting to disintermediate the lawyer or disrupt the lawyer is a self-limiting belief. I think you guys should plug in an AI lawyer, make it one-click deploy, standardize the terms, create 3 variants and flavors, and like you guys would create massive value. I mean, conflict of interest disclosure here. I'm actually a shareholder in a company called Cake, which I think is sort of nibbles around the edges of Carta and is meant to make it very easy to sort of issue equity and sort of figure out your price round. So I think both companies should just be doing this as one-click deploy, powered by AI legal advice.
So the second part of the sort of the cap table and the dilution question, where I think a lot of founders are not very clear, and I feel this myself, and I know you've also got data on this, Peter, is employee equity. And I'm speaking specifically about early stage startups with early employees. And another thing that dilutes founders potentially is having that ESOP pool. But what I often see is that people have quite a big ESOP pool, but then they're actually quite stingy in handing out the equity, and it's confusing. But like, what do you see out there in terms of employee equity for early employees? And to the extent that you think there are benchmarks and best practices here, what would you advise?
We've got tons of data on this, and I think it's a fascinating set of topics, actually. So first thing, you made the clear point, which is oftentimes founders will set an employee stock option pool at a rather high number, maybe 15 or even 20% of the total fully diluted cap. My advice is that is too high. I think founders do that for 2 reasons. One, they maybe have found that from a lawyer or something and they didn't get a lot of good advice. And the second is they don't really realize that your ESOP will be a part of the conversation towards expansion every single time you fundraise from investors. So this is an expected part of the negotiation, and you'll have lawyers and other people debate it back and forth. What we see as standard best practice at the moment is that when you are a pre-seed company, you can start with an 8, maybe 10% max ESOP pool, and then you're going to give that equity out to early employees as they come onto the business. For instance, last year, the median amount of equity that was given to the first hire at a tech startup was 1.5%. Now, some listeners might think there's no way I would join for 1.5%. And some listeners might think, that sounds pretty good. That's pretty high. And the range is quite wide. This first hire might get 0.5%, which I think is quite low. They might get 4%, which I think is quite generous. So it's all over the place. The benchmarks here are far more guidelines than they are strict rules. But it is very true that it is, especially in these times of lean teams, most early stage startups do not fully utilize their option pool by the time they're getting to seed or Series A. There's quite a bit of equity left in the pool when they approach those times. And if teams are going to be smaller, my suggestion is that you should be more generous with equity to those early employees because they're going to make up a bigger portion of your headcount. But hey, we candidly haven't seen that much change in it over the last few years.
So just the final insight that I saw you share about ESOP or employee equity, which I thought is really interesting, is the fact that because employee equity vests, a lot of it comes back to the company.
This is the hidden, unspoken, unsexy, sometimes negative part of employee equity. So first off, I am in favor of vesting schedules, meaning the employee vests equity, earns equity effectively as they stay longer and longer at the company. I think it aligns incentives. I think it makes total sense. What happens, especially in the States, however, is that this equity is granted as incentive stock options. And those incentive stock options have an exercise price. So the employee has to do two things in order to make that equity actual stock. They have to stay long enough, and then they have to pay actual exercise costs to make that equity their own, to own those shares. And oftentimes what happens is an employee leaves the company during their vesting, maybe 3 years in, and they're faced with this 90-day period. And in that 90 days, they have to come up with a bunch of cash to exercise their options. The stat that I thought was pretty mind-blowing that we put out recently is currently 70% of employees faced with that 90-day decision decide to not exercise their equity. And they just let it go back to the pool. And it's as though they were never given equity in the first place. Are they making smart decisions? In many cases, obviously, yes. Maybe they're leaving because they're like, this company's not going to be worth anything. Maybe they're leaving and they got laid off and they have some emotional distress with that company. Maybe they don't have the cash on hand and it's a lot of money and they just can't do it right now. There's a lot of good financial reasons. But in general, I'd say that founders can often expect about half, maybe even more, of their issued employee equity to actually return to the pool and be available to be reissued to other employees as employees actually start leaving.
So again, Peter, speaking about, data that you guys have on hand, do you have any insights in terms of statistically speaking, whether that is on average a good decision or a bad decision for those employees?
I mean, on average, it's definitely a good decision, but that's only based on the averages of startups, right? Most startups do not ever.
On median, it's a good idea. I think on average, maybe it's a different question, right?
Well said. Most startups will never experience a liquidity event, so therefore the equity is definitely worth nothing. Now, the interesting part is, narrow the analysis just down to late stage companies, Series D and beyond. So these companies should ostensibly be worth something. Even in that realm, about half of equity goes unexercised, which either means it's a lack of education, it's a lack of trust in the company. Maybe there were a bunch of overvalued companies that these employees no longer believe in, or founders and others got to do a better job of telling people how this actually works.
Or it's a lack of liquidity, right, Peter? Like people need to put up money, cold liquid cash for shares that still might be several years away from an exit.
A few areas where Carta could help.
We do a lot of equity education. It's one of the things we've invested in the most.
I don't just mean education. I mean funding. Yeah, here's a loan to go buy your equity.
There are a bunch of companies that will do option-based financings. We're not one of them, but there's a lot of different options out there for that. Sometimes those are really good and employee-friendly. Sometimes they can come along with terms. So if you're an employee thinking about using debt to finance your equity purchases, be very, very careful with that. Because there's no guarantee that equity is going to be worth anything in the future. And now you get to liquidity. You said the big word. Startups are staying private so much longer than they used to. So what happens to this whole world if instead of a 10-year life cycle, it's a 15-year life cycle? How do people get money out of these startups along the journey? Because you cannot just wait 15 or even 20 years to have any sort of waterfall back to investors and early employees.
Secondary markets.
Secondary markets is a big one. We're seeing that explode. M&A is rising, but it's definitely not going to take the place of a well-functioning IPO market. And IPOs are back, quote unquote, weekly back, I would say. We haven't seen that many great ones. And many of the private companies that you would want to go out to the public markets most, they're just choosing not to go public because they don't need to, not because they couldn't. And I think that's a new dynamic in venture that we haven't seen before.
Yeah, I think this is actually potentially an increasing trend, right? This idea that there will be these more formalized secondary markets that are off grid or off the public markets and with, powered by blockchain or fractional ownership of some kind. I know this is happening already, but I think it's, short of regulation that, nips it in the bud. There's going to be an opportunity to disrupt the formal markets and go do this in a digital first, maybe blockchain first way.
Yeah, it's an interesting concept. I think that even beyond, if you want to move beyond blockchain, what you have seen is all of these super late stage private companies that are well known. Many of them are doing employee tender offers to give those employees some liquidity, sometimes annually, sometimes every 6 months if their valuations are rising fast enough. And so that is a new dynamic. There's the joke in San Francisco these days that whenever OpenAI does a tender offer, the rental market, explodes again, and most people are priced out of houses again in the
Didn't
Bay.
one or two of the venture funds also create sort of additional funds or mechanisms where they could start to hold on to these companies over the long term?
Yeah, so they've either become
Evergreen.
RIAs, in which case they can hold in the public markets, or they've launched continuation funds, et cetera. There's a whole lot of late stage fund construction that is dedicated to saying we would like to hold on to Stripe forever, for instance, no matter what they do.
It starts to look more like PE, right? Venture friendly, founder friendly, growth friendly, PE versus sort of just bringing in a company and just, optimizing it and letting it, BAU.
I've long felt that venture capital is becoming a very strained term, and it actually covers too much of a market, and we need new words for different parts of venture. So
It's almost like venture operations.
yeah, insofar as you have terminology ideas, I think we'd be happy to hear them.
It's one of my favorite things to do.
So Peter, like the next thing I wanted to talk about is something that's, I think, quite close to my heart and a lot of people's hearts, which is founder dynamics, founder breakups, and also what that means for founder equity. So you've got some pretty startling statistics on how many companies, how many early stage startups experience founder breakups. So maybe you could share some of the highlights of those.
Yeah, this is one of the fascinating data points that we get to dig into because so many companies are joining us super early on in their journey. So we can watch the equity dynamics change from literally day one for a lot of these founders. So when you talk about a founder breakup, I think one thing that's been true for a long time is that venture investors are usually more excited about funding companies that have co-founders. That has been true for a long time. There's been an anti-solo founder sort of bent towards venture. And I can explain, I'm sure that the listeners can explain some of the reasons. There's someone to take over if something were to happen to the other founder. There's a complementary skill set benefit, all of that kind of stuff.
We've had a whole episode on that very topic, yes.
Yeah, exactly. When you look at co-founders, so teams that had 2 or 3 founders, the very clear pattern is that more of those teams are losing one of the co-founders. The co-founder is leaving the business earlier and earlier. So at last count, about 20 to 25% of companies that have been around for 4 years have lost a co-founder over that time. And some of them died because the co-founder left, so they're not even included in that 4-year mark because they didn't make it. I can't really see, unfortunately, why the co-founder left. I'd imagine some of them are acrimonious, some of them are, harmonious, and probably not that many, to be honest. But it is something that more and more founding teams are having to deal with, and this makes founder vesting so important. And again, venture is not the only way to build a business, but if you're going to take venture money and 40% of your company is already gone because the co-founder left in year 2, it's going to be really almost impossible to fundraise from VCs. It's just a lot of dead equity on the cap.
You have to clear the founder off the cap table. You have to recap. Yes, the founder has to renegotiate. And the message is some version of you guys get 100% of your equity of nothing,
Yep.
or you help us restructure this so that you can at least get a little bit of something. Otherwise, you're both shooting yourself in the face.
That's what founder vesting is precisely designed to achieve. So you don't have to negotiate it at breakup time, but you negotiate it up front. It's your prenup, right? Isn't it? So founder vesting is basically saying that instead of getting all your shares, let's say it's a 50-50 split, you get all 50% at once. It vests much like an employee stock option. The mechanism is different, but in reality, the practice is the same. And one thing that I saw you mention, I've heard a couple of people talk about lately, so I'd be interested in your thoughts. So traditional founder vests follow the model of traditional employee vests, which is 4 years with a 1-year cliff. And the question comes up is 4 years really long enough? What are your thoughts on that? And are you seeing more longer founder vesting schedules?
Yeah, this got me a little bit in hot water with founders, and I totally understand why. But the thinking here is that actually a 6-year vest might be more appropriate for a couple reasons. First, companies are staying private longer, so the journey is taking a longer time. Second, perhaps more importantly, many investors are requiring revesting of that equity anyways along the road. Thirdly, again, if your co-founder leaves, it can be a giant drag on the business. If you have a longer vesting schedule, they will have vested less of their equity at the moment of leaving. Therefore, it's an easier proposition. Now, the founder pushback, which I think is totally reasonable, is one, this is my company, screw off. Totally fair. Second, and maybe more well articulated, is, well, why would I change the vesting schedules? I'll do the 4-year because it protects me. But if the VCs are going to require revesting as part of the negotiation, well, that's an arrow in my quiver, and I should not give that up front. I should make that part of the negotiation. Maybe I can get a better valuation. Maybe I can get a better deal term if I include that revesting as something that's part of the negotiation of the round. And I think that is also fair. The last point here is, what do you do about founders who contribute capital, real dollars, to the business up front? How is that equity recognized? How is that contribution recognized? And then that gets tricky if you're going to give those, like, should they get preferred shares for that capital, but common shares for their general funding? It can get really kind of messy in the middle there. So I totally understand why founders maybe didn't like that take from us, me, I should say. That's not a Carta take, that's a Peter take.
Yeah, the main takeaway from me, Peter, and again, I've experienced it. Like, I'm a second-time founder who's been through a breakup with a co-founder who's also on their second marriage. I think in both our cases, they were fairly amicable breakups, but nonetheless they happened. And to your point, when a founder leaves, if it's not properly managed, it can kill the company.
Yep.
And it is very, very common. I think that's the bit that doesn't get talked about enough, because I think when a founder leaves, it's generally kind of swept under the rug. It's hushed up. The fact that nearly 40% of startups lose a founder by the time 7 years are up. Even after 4 years, it's about 25% and getting worse, according to your data. Like, that means that it is normal. You should expect it. It's not guaranteed, but it's a likely outcome. And so you guard against a likely outcome. This is something you need to be thinking about at the beginning.
Couldn't agree more. I mean, it's like the statistics on divorce. It might be actually worse, to be honest, at this point now. And then the last suggestion that this sort of highlights is, are the typical reservations about investing into solo founders losing some of their applicability? And a solo founder company will not die because of a founder breakup. It's not a reason that company is going to fail. And I do think that there are a lot of people in SF and elsewhere who are saying, look, in this age of AI, solo might be a resurgent sort of type of founding.
We often take credit on this show for being the ones to sort of super popularize this idea of $1 billion 3-person company. Jeremiah Ouyang and Ben Parr mentioned on the show, and then Jeremiah posted on LinkedIn, and it hit millions of people. I'm still to this day relatively skeptical about this idea. I think you need essentially an executive team. In the fullness of time, right? You need one person for each major function, right? Finance, product, engineering, what have you, because those people care deeply about that function and need to operate that function. Now, they may have an entire team of AI underneath them, but I think you need somebody who cares. And I think it's still true about founders as well. You need somebody whose brain works in a way that is about storytelling, about fundraising, about sales, and someone whose brain works around, product and details and, execution, and wants to sit at home and sit on their computer and work, right? And a few other bits and pieces. So I think the multi-founder model still has important validity and will continue to play out. That's my instinct. And you just have to, as Yaniv said, kind of account for the fact that you are probably going to lose a co-founder or two along the way, and that just has to be part of the plan.
I feel like there's a way for solo founders, and to be clear, I think I mostly agree with you. There's a way for solo founders to use the extra equity in their advantage, right? Look, if I am a solo founder and I have 35 to 40%, quote unquote, more equity than I would have had I had a co-founder, can I increase the generosity of those founding engineer, founding business hire, founding marketing, et cetera, packages, and build a team of rivals, an all-star team that it doesn't quite rise to the level of a founder? Because here's the thing. Weirdly, once you get to the end, there's almost always one founder, right? We don't talk about founding. We talk about CEOs we only talk about one person for these major successes. Even if they had, we don't talk about the co-founders at Airbnb at all. It's really just Brian.
Maybe let's generalize the sentiment then. You need a small group of highly invested people to help get you through that initial phase of launch. Yeah. And whether they're founders with, a serious amount of equity, or, almost equal potentially, or whether they're just highly motivated people with a meaningful amount of equity, but not equal. And you might call them first engineers or first whatevers. Maybe that doesn't matter so much.
We didn't talk about the equity splits, by the way. Equal is getting more common. Every year, more and more of the two founder teams that we have just split 50-50.
Is that a change, is it?
It is a change. Every year, it used to be about 30 to 35% of those companies split 50-50. Now it's more like 45, getting closer to half. But across the board, that means if you just look at the data, if you include 2 founder, 3 founder, 4 founder teams, most of those teams will not split equity equally. They will choose something else. To be clear, most of them are not like 80-20. That's also very uncommon. But 51-49, 55-45, like everything in that spectrum is in some ways more common than the equal off the bat.
I mean, I kind of feel that with founder vesting, especially if you go for a longer schedule, then that is kind of your mechanism. Instead of having uneven splits, you're like, well, if we're both still there at the end of 6 years and we've probably added equal amounts of value, if one founder is not pulling their weight, then they're probably going to be gone and they're going to give up a chunk of their equity through the vesting mechanism.
I think that's a slightly different solution to a slightly different problem, right? So I think different founders come in with different levels of experience, talent, contributions up front, and then their commitment and contribution might differ in the back end. Then you add on top of that capital invested, which I think is a different story with a different allocation of equity for a different reason. And so I think each of these plays a slightly different role.
And I think as long as you talk about it in front, you've done a good job. Any way you split it, just have the conversation.
All right, Peter. So maybe our last question here. We've had episodes about, when to give up and the difference between tenacity and discipline. But do you have any data on, when should a founder quit? How do you know if it's time to throw in the towel?
I'm not sure our data is good at saying when a founder should quit. We can't tell you the day after, if you've been at this for years and years. What we can say is there are many, many, many founders who have yet to quit, for whom the likelihood of success is vanishingly thin. If you just look at Carta, for instance, and you say, when did you last raise your round? And there are some that raised the Series A in late 2020 who have not raised any capital since then. They may have taken no extra financing. And this begs the question, so what are those companies going to be? And some of them will get to profitability and they will become small businesses, and that's awesome. Some of them are just extending this cycle of they're trying every last thing before shutting the company down. This is an odd dichotomy in Silicon Valley where we celebrate people who have failed. We celebrate second-time founders. We celebrate failure as a learning opportunity. And I think that's a wonderful part of the culture. And yet also we say, never quit. Quitting is bad. Those two things can be in some ways, in contradiction to one another. And I think it's a problem that many founders sort of don't understand. And in this age of AI, maybe there's a lot of wasted talent of founders that are stuck at companies that are not going anywhere that could do their second thing. They're just not willing to do it yet.
Yeah, we've talked a lot about opportunity cost and knowing when to quit on the show. And, we've also talked about this idea that for every scenario, there is equally popular conflicting advice.
Yeah.
To go both left and right. And, knowledge is knowing the advice. Wisdom is knowing when to apply it. Sometimes it's also a little bit of a stab in the dark and just depends on your own feelings and commitment to the process. So it's one of those things that's an art as much as a science and personal choice as much as anything else. But the way you reversed it, I think, is very clever, which is there are companies that are clearly in zombie mode that are burning opportunity cost for the founder and burning opportunity cost for the entire industry. And people are just worried about their reputation or some other different thing. And those are probably worth packing up, going home and starting again.
I actually think even more than reputation, it's something more noble but misguided in the case of most founders. It's some combination of, I guess, pride, not wanting to give up on something, that's stubbornness, and this sense of not wanting to let their investors down, which I think is the most misguided part of all, which is saying, oh, okay, I've taken investors' money, I've burnt some, most, or all of it. And so shutting it down is giving up and I'm letting my investors down. And I'm like, if you have taken money from the right sorts of investors, which is, angel investors and venture capital firms who are risk on, who know the game that they're playing, smart money, then they are going to be 100% behind you quitting as long as you're doing it for the right reasons and they seeing the same things that you see. They're not going to be pissed off at you because you're not giving them their 10x return or giving them their money back. They're going to be saying, great. If they like how you've run the company, even if you failed, they're going to be like, let me be first money in on your next startup, right? They don't want you to be wasting your talent either. So don't have that shame. It's easier said than done, right? Of course. But when you see that you have no viable path to generating the sort of return that your investors want and that you want to see, then there's no point just grinding away out of some sort of stubbornness or misguided sense of duty. You are doing nobody any favors.
Pick your investors wisely, and they'll support you through a lot.
Well, Peter, it's been an absolute pleasure. We could keep going on for so much longer, but it's time to wrap up. Now, you put out so much fantastic content. We have really just scratched the surface of all of the insights that you share in your role of Head of Insights at Carta. So if people want to follow you, want to learn more about the insights that you are putting out and the analysis that you do, where should they go?
Of course, you can find me on LinkedIn. We publish basically every day there. But if you want our full-fledged sort of archive of all the reports, the podcasts, the newsletter, everything that we've ever published, it's a simple URL. It's carta.com/data, and you can find all the data that you want there.
That's right. That's Carta, C-A-R-T-A. Most people will know how you spell it, but just in case, carta.com/data. Fantastic.
And Yaniv, how can people find you on the internet?
I'm on LinkedIn, trying to make it a less boring place. I love getting connection requests from TSP listeners, so hit me up with an invitation, let me know you're from the pod, and I will accept it. How about you, Chris?
You can find me on all the social media, and especially LinkedIn, or at my site, chrissard.com. All right, guys, we'll catch you in the next one.
This episode of the Startup Podcast was brought to you by Cyber Matters. Startup security doesn't need to be painful. Cyber Matters runs complex compliance programs that keep you audit ready and focused on growth. Check out cybermatters.io to learn more. That's cybermatters.io.